matrix trade, a new service, an innovative macro approach to currencies, stock indices and commodities. Many of you will know me as a technical trader with an economic and political background. Well, matrix trades brings all these elements together with evidence-based macro analysis, trading and education. So what would you do if there was an earthquake? Well, pray. Apologies for the example, but it serves a purpose. We should at least say a prayer for all those sadly affected. Should we panic? As traders and arguably less analysts, we can't afford to panic. We have to be prepared as best we can. As Charlie Munger, Warren Buffett's right-hand man, said, 3 things they always do is prepare, prepare, prepare. Once prepared, proceed and hopefully profit. Well, how? If I were to ask you what really moves markets, I'd get probably 200 answers. And you'd probably all be right at different times. But to understand what is really moving a market, we need evidence now. So when people tell you what's going to happen, whether it's a pundit reasoning deductively or a technician telling you a particular formation will work, ask them simply, where's your evidence? The best evidence is performance, and therefore price is the best measure of performance and price action. In other words, the best evidence of what will happen is what is done before in similar circumstances, or in price action terms, a fractal. A fractal is nothing more than a piece of price action that can be identified and compared. A fractal is nothing more than many other things in life, like how the sun rises in the morning, we expect it to go down at night. So what does the evidence tell us then about earthquakes? Can we identify and compare earthquakes? Well, surely not. There have been 3 major earthquakes this century in Japan. So what would we do? This is a dollar-yen chart. What would we do to the yen? Well, at the end of a possible long-term downtrend in dollar-yen and clear momentum loss, you'd buy, right? Crisis, instability, bad for a currency. They'll have to pay for the right reconstruction. So higher, right? Yes? Oops, wrong. In all 3 cases, the yen strengthened. Most notably in 1995 when Nick Leeson lost his bearings. He had the same idea. Dollar-yen plunged. The reason was simple. The market was quick to go long in the midst of a counterintuitive repatriation of yen to help fund the reconstruction. So what do we do then? We buy more or we liquidate like bearings? Well, we're trading in retrospect, so we buy more, of course. And wow. With the help of the Bank of Japan intervention in the last 2 cases, we're right, we're more than right. But notice how all 3 are moving together. I wasn't there in 1923, but in 1995 and 2011, there was a widespread feeling, particularly in the retail market, that this was too much too fast. It's the top of the previous range, so therefore many sold out and shorted way too soon. But they were ignoring the real drivers, the historic jumps in volatility, the reconstruction, the Bank of Japan funding, and major hedge fund buying, not just in dollar-yen, taking dollars out of the market that wouldn't come back, but also selling yen across the board and buying Japanese government bonds and the Nikkei as well. Which is why it keeps going higher. Forever? Of course not. A 5-wave trend sequence, a momentum loss, fundamental drivers in dollar-yen and related markets starting to fade, the correlations breaking down, there is divergence, and yes, head and shoulders, and whack. So why? Why are they the same? 3 very different times, 3 obviously similar sad events, but whose effect can't be all put down to an earthquake. We can't expect this price action all as a result of an event 3 or 4 years previous. The answer in a sense is simple. What really drives markets, in this instance, the drivers and the price action have been similar. It fits. And by fits, I mean the fundamentals, the intermarket relationships, the technicals, and the sentiment. Fundamentals, the real world that is, that are supposed to drive markets but seem strangely disconnected or delayed or early at times. In this case, the earthquake and the government response clearly drove the dollar-yen uptrend. The intermarket relationships, the relationships between different markets, the foreign exchange market, the stocks, the bonds and commodities that gave dollar-yen's uptrend enough breadth through the JGBs and the Nikkei to be sustained, but also highlighted significant divergence at the tops and bottoms. The technicals, at each and every point, there is or was in this case an appropriate technical formation that's consistent with or supported different phases of the trend, correction and reversal. Now it's great to use RSIs when a market's ranging in a correction or moving averages in a trend. Elliott wave and channels in trends, divergence, momentum indicators at tops and bottoms. And arguably the most important, sentiment. And by sentiment, I don't just mean the decisions you and I as traders make subject to similar motions and timing, but also robots who are necessarily programmed to repeat themselves based on the same data confronted by similar circumstances. So that is what matrix markets does. It seeks to identify what is really driving a market, tracks it using the right indicator at the right time. And how do we do that? Well, evidence, and the best evidence for each is if it's measured by price and price action, or what we call fractals, a piece of price action that can be identified and compared with previous price action, an event, or other markets. So what is the best evidence that what a market will do? What it did in similar circumstances before. So what did dollar yen do now? I'm not trying to convince you that history repeats itself all the time, because it doesn't. All I would ask you to do is this, simply. Evidence your analysis and apply the right tools. So, where is your evidence? Evidence-based fundamental analysis. Today is not only the launch of matrix trade, but also NFP. It's quite amazing how markets have a habit of following similar patterns into major economic events and, depending on the outcome, similar patterns after. This just happens to be the last Euro-Dollar NFP fractal for last month, but still pretty amazing. And this is the S&P for this month that says pretty much it's a sell into NFP, but looking to cover and buy it later. If it continues to follow a certain path, following the previous NFP fractal lines, then we continue to follow and trade it. And if it doesn't, we don't. And it's a similar story on more substantial, longer-lasting fundamental events like central bank policy. When the states raise rates for the first time, this has been the effect on dollar yen. Again, these haven't been handpicked to show similarity. These are the last 4 times the US raised rates. And each time you would expect dollar yen to go up, right? No, they went down. It went down 3 times for 3 months and then rallied. And yes, it's the same as our earthquake projection. Funny that dollar yen falls as it has done before. And interesting, the closest comparison is actually 1999, when they raised rates after a nation crisis that triggered an oil price collapse and recovery. But this time there was no earthquake. Not unless you were trading gold. Not just our customers, but any of the 25,000 who follow me on Twitter may recall the heads up we gave before one of the most violent, earth-shattering gold rallies, a very close copy of the Washington Gold Agreement rally in September 1999, 3 months after that time the Fed raised rates. The beauty of markets is not just they present these occasional evidence-based opportunities, but they keep doing it frequently in succession. So, 76 days later, we and oil did something very similar to gold, not only following a same pattern as the Washington Gold Ramp in 1999, but also OPEC's oil-inspired rally in 1999 as well. That projected a minimum of $45 in April, which we've obviously hit, so we've taken some profit and restructured the trade for a possible 75 to 78. Similarly, dollar Canada, the oil surrogate, has followed its lead, dollar Canada's lead from 1998, but also oil. And the same for the S&P, and the gold surrogate Aussie, and even Euro Sterling has followed the same template, all at different times. In fact, it's hard to find any of these markets really moving together at the same time, which explains why evidence-based intermarket analysis is so underdeveloped. Correlations are much more powerful when you suspend the time variable. Many more markets correlate across different time periods. It's the structure of the price action that's important, not the time. Because we know or we believe certain structures produce certain moves, we believe in technical analysis. There are many different technical formations or outcomes, but they're still all fractals with a particular shape or form and outcome, with a particular probability, but not always the same probability or outcome and in different times or in different markets. Now take the classic example of the head and shoulders, and this example of the euro-dollar repeating itself synthetically before it came into being in 2009 and afterwards. Before 1999, effectively the inverted dollar market pulled back over the head and shoulders neckline before going only 75% of the way to the target but not reaching it. And the euro-dollar so far has done the same thing. Did you know that head and shoulders in Asian and American markets work more than 50% but generally fail more than 50% in European markets? They also succeed more when it's not a fundamentally driven market but a technical market where sentiment readings are over 75%. For those of you who use Elliott Wave like myself or want to learn, there's much more to it than ABC 1, 2, 3, 4, 5. There is the spirit of Ralph Elliott. that had the foresight to embrace all the fundamentals, the intermarket relationships, technicals and sentiment that fits analysis. And this chart will be available on matrix.trade.com. I can't even begin on evidence-based technical analysis. Did you know dollar yen generally corrects the Fibos 23.6% to 38.2% in fundamentally driven markets, but more than 50% in technical markets? In cable's case, that's more sometimes than 100%, and I'm not even joking. Sentiment drives markets, human and algorithmic sentiment. From Jesse Livermore to Benwell Mandelbrot, who coined the term fractal in the 1970s, to the Bank of England in response to the 2008 crash, evidence shows that markets confronted with similar conditions repeat themselves in similar ways. The question then is matching those conditions and the resulting price action. Now, since the explosion of high-frequency trading algorithms in 2008, the number of times markets repeat themselves in the real short term is staggering. Hence the term staggering fractals, where US market shapes the Nikkei 8 hours later, while BP8 shares in Australia frame the German DAX 8 hours later, and then that drives the S&P quite often. This chart of staggering fractals is indeed staggering and shows how often markets repeat themselves over and over and over again in the real short term. It is this interaction of buyers and sellers, human or otherwise, that highlights what is really driving markets at different times, but helps you stay consistently ahead. So rather than fits analysis, what we try to do is sift to find the highest probability and the best risk returns, and with the help of history then we try to shift the odds in our favor, because that's what Matrix is about, finding the best trades, and Matrix signals seek to do that just by trading what is really driving the market, finding the best probability and the best risk returns, but also using the market's trade history to find the best trades and increase our payout. Evidence-based trades, if you like, a quantitative approach to qualitative analysis. So what about the UK's earthquake? We going to Brexit or don't regret it? Come and join us. Thank you.